Happy New Year, ladies and gentlemen. Happy 2019 and welcome to today's presentation. We're going to discuss the trading goals for 2019. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education at radioactivetrading.com and at poweropt.com as well. Now, 2018 is in the books. It was a pretty interesting year. But we've got to look back now and assess what worked briefly, what did not work, of course, and then decide what we want to do in 2019 to enhance what did work and to minimize what didn't work. And 6 out of the 12 months in 2018 showed us negative market performance. Some of that negativity came suddenly. February 5th to 9th, the volatility crash. Middle of December. Middle of October, we saw sudden movements that may have just wiped out positions before we could even get to our trigger points or before we could even get to a proper management. Some were more extended. Of course, if we may have caught a little bearish move at the beginning of November, at the beginning of December, we could have adjusted our positions, changed our direction, or been able to profit in both directions, if you caught it exactly right. The fluctuations that happened in between, you could have turned a bullish spread into a bearish spread, only the next day to see the market recover 200 or 300 points and now have your new spread or your new position being threatened. So it's a little whipsaw effect, which makes it very difficult for management and very difficult to profit long term. So what did work? Well, many favorite option strategies, popular option strategies, would have worked for a few months out of 2018. Popular premium generation strategies of just doing covered calls, naked puts. Very popular leveraged option strategies, credit spreads, bear call credits, bull put credits, maybe debit spreads taking the opposite sort of transaction, but still having a parity trade to a bull or bear credit. Neutral condors and butterflies maybe would have worked well from, let's say, March to middle of March, before that March 5th to April 20th movement, and maybe from April to June, before the June collapse, and then maybe August to September, before the sudden shifts happened again. Straddles and strangles would have also been profitable, buying straddles and strangles, but only at the right times. Whereas a lot of time decay and a lot of loss would have happened in those stagnant to neutral markets or the gradual markets, and then big profits when there was a market shift, if you were properly structured. Of course, what didn't work are those same strategies in negative market conditions or adverse market conditions. In a standard covered call portfolio, 1 month out or 1 week out, you might expect 1 to 2% return on a position. If you have 5 positions open, then you hit one of these downturns, you watch all of them drop 8 or 9%, maybe more, maybe a little bit less. But we've got a capped gain and still 97, 98% of the risk of owning the stock outright. Credit spreads. Well, usually when you structure a credit spread, you look for that higher probability, 75, 80% probability of success, which is going to put you in a position that carries maybe an 8 to 1, 9 to 1 risk-reward ratio. Some of those sudden movements we saw, February 5th through 9th, or of course even in December, you might have suddenly hit the trigger or hit the maximum loss on the trade or close to it and wiped out 8 or 9 previous wins. That might be as much as 2 or 3 months of successes wiped out in one instant. Diagonal spreads, poor man's covered call, strategies like that. Very popular, using leverage instead of getting into the stock. Hopefully you're properly structured. But when the stock falls 10%, which we saw happen in 20 to 30-day periods, even less during 2018, that leverage long call might be down 35%, 40%, or 50%. And if you're overinvested in that trade, that's taking down a bigger portion of your portfolio. Condors, butterflies, things of that nature. We see the same thing with credit spreads. get a little bit extra premium in an iron condor, combining two credit spreads, but still with these unexpected market turns, unexpected market conditions, we're wiping out 5, 6, or 7 previous wins when we hit a loss. And we may have had positions that had lofty expectations. After 2016 and 2017, the first month of 2018 in January looked fantastic, riding a high wave. And if we expected that trend to continue, whatever strategy you were using, you might have expected the same trend and expected the same types of returns you saw in the previous years. That might have set us up for even a bigger catastrophe going forward, as the structure might not have worked in our favor in a whipsaw market that we had, as opposed to enjoying the wave we had in 2016 and 2017 as well. And there were chances to make money. A lot of stocks showed double-digit gains, some higher in 2018. One of the stocks I posted for Fusion subscribers had a gain of 85% during 2018, in Canada Goose. Another one was up 40%, Ollie's Bargain Outlets, from the purchase price. And that's just some of the positions I had. More stocks gained much more than that at one point or another in 2018. Just like a John Mellencamp song, there were winners and there were losers. I had a stock drop 30%, and I was in it for that entire time. I had another stock drop 33% in 30 days, but was able to take a 10% profit on the pen position that dropped 33%. And between the two 30% losers, I had an average gain of 8% because of a proper structure and having the right tools available to manage the positions. But let's take a baseline. All right, we want to talk about your trading goals here, and we want to fire off a few things to see where you are and see what happened. First, what strategy represented the bulk of your portfolio during 2018? Were you mostly trading stock only? Were you looking at covered calls or covered puts? Covered calls or naked puts, income generating positions? Were you doing credit spreads, debit spreads, or condor positions? Were you doing calendar spreads, diagonals, maybe horizontals, or possibly even buying straddles or strangles, maybe selling straddles or strangles? Or were you doing other strategies? And let me know those in the comments. Just use the question pod there to send me what strategies you were using with the bulk of your portfolio. Okay, we're going to just leave each poll open for about a minute or so, as we want to get a good gauge here of where everyone stands. All right, of course, we do have more people joining us in the room, as we're just after 12 noon Eastern Time. So I encourage you to go ahead and vote, as this will help us all sort of better see where we stand and what happens with our strategy. We've got a 4-way even split right now. Oh, excuse me, needed a quick drink of coffee there. All right. So I'm going to go ahead and close the poll. Still encourage you to vote if you haven't yet, but let me go ahead and close that poll. I'm going to share the results with everyone. 25% of you were doing stock only. 25% of you were doing the credit spreads, bull puts, bear calls, debit spreads, maybe including condors. 25% of you were doing the time spreads, diagonals, maybe horizontals or straddles. And 25% of you were doing other. No one said they were doing covered calls or naked puts with the bulk of their portfolio as well. Okay. Okay, so part of one of the answers that came through there, Charles posted in and said he was doing protected positions, married puts. Okay, well, let me go ahead and hide those results. And what I want to know is, we started off 2018 riding a wave. We had a great first month for anyone who was doing bullish strategies. But what were your goals for 2018? Do you want to see an overall portfolio return of 10% for 2018, and anything else above that was considered just excellent or gravy? Cover calls, naked puts, where you're looking for an average of 2% per month, say around 20 to 30%. On the leverage trades, were you expecting, even factoring the losers, making 5% or more average per month, taking you close to maybe a 60% win? Did you want more than 50% gains based on riding the wave we saw in 2016 and 2017 and hope that would work? Or did you not have a goal and you just stuck with strategies that worked for you in 2016 and 2017? Okay, so I've had the poll open for about a minute and 30 seconds. I'm sorry, we're just going to have 3-4 quick polls in a row. We'll get right back to it, I promise. I just want to get a baseline here of where we stand. Let me go ahead and close this poll. Let me share the results with everyone. So 60% of you, reasonable expectation, I feel, 10% or more. That's kind of what I shoot for, 10% overall. 33% of you were looking for that 2% per month. Some may even say 3 to 6% per month with covered calls, which I don't feel is realistic. But 2% per month, around 20 to 30. No one was expecting 5% per month. No one was expecting more than 50%. And thankfully, all of us had a goal and had a plan in mind. All right, now, did we do that? How did this work out for us? How many of you met or exceeded those goals that you set in 2018? How many of you were close to your goals, didn't actually meet them? Was anyone at break even, maybe a little bit more, a little bit less? Those goals that you had, did you hit the mark, but with a negative value? Or were your 2018 goals completely missed and your return turned you away from trading going into 2019? Okay, so we've had this poll open for close to a minute, ladies and gentlemen. I encourage you to vote here. One more follow-up poll, and that's it for a while, I promise. And then we're just going to get right to what we need to do and what our trading plan should be for 2019. All right, let me go ahead and close that poll. I've got an even split here for those of you that answered. Oh, there we go. Changed again. That's good. That's good. I'm going to leave it open for a little bit more. Encourage more of you to go ahead and vote. Okay. Let's go ahead and close that poll there. I'll share the results with everyone. So no one met or exceeded their goals for 2018. 25% of you were close to those goals. And 50% of you are break even, a little bit more, a little bit less. No one said that they hit the mark but negative, but we did have 25% say that the losses from 2018 are turning them away from trading in 2019. And last but not least, finally for now, just a real quick one. Looking over your trades from 2018, what do you think was your win ratio? I don't mean percentage-wise. I just mean of all the trades you entered, what was your winning ratio? Did you have a win ratio? About 70% of your positions were winner at least break even or higher. Was that up to about 80%? Were some of you right about 60% of the time? Were you at a 50-50 win-loss ratio, or did you have more losers than winners? All right. Okay, got a lot of participation in this one. That's fantastic. I'm going to leave it open for a little bit longer, and this is the last poll, I promise, till the end of the presentation. We need to just get that baseline. That's all. All right. Let's go ahead and close the poll. Let me share the results again. 33% of you had winners 70% of the time, winning positions. No one was 80% or more, and good. So we had people 70%. No one was in the 60 to 70% range. 33% of you were at the 50-50 win-loss ratio, and 33% of you had more winners than losers. Now this is interesting because we had, as we saw, 25% that met expectations. They were close to meeting expectations, didn't actually get it, yet we have 33% who are right 70% of the time. How can we be right 70% of the time and still not be met or exceeded our expectations? Oh, sorry, now we have a baseline. We see the strategies that were used. A good mix of stock only, covered call, naked puts, credit spreads. We've seen that we had the expectations. Most of you were at just about a 10% range or more. Some of you wanted 32% to that 20 to 30% range. Kind of realistic, all of that in my opinion. And we've seen how those have worked out. Only 25% of you got close to but did not meet your expectations. 50% of you were at break even, and 25% of you ready to turn away from the market, even with 33% of you being right 70% of the time. Are we in a no-win scenario with option strategies and trading options? This to me is a common myth of options trading that's a zero-sum game. If you have a successful covered call, you figure that someone had to lose on the other side. Well, we know that's not true. If you got into a covered call and someone bought the same call to you, there's usually a buyer for a seller in reverse. But what you don't know is the structure of the other person. If you entered a covered call, bought a stock at 50, and sold, let's say, a 50 call for $1 or so, well, you might get about your 2% expected return if you're assigned. The stock moves up 10%. The call buyer did really well. You did okay. You met your goals. Who lost? The person who shorted the stock. Okay? So not everyone lost. 2 out of 3 made money. Also, though, if you get into a covered call position, you sell a few contracts, 4, 5, or 6 contracts, there's got to be a buyer on the other side. That buyer might be doing a bold call debit spread. He might be buying the 50 call and selling a 52. And if the stock moves up, that buyer might see a very strong double-digit return. You make a profit. So who lost in that scenario? Well, potentially the other call buyer at the 52 strike, depending on what they paid, and the person who shorted the stock. So it's about 50-50 there, but the wins might have outpaced the losses, or vice versa. So you don't know the structure on the other side. You can't assume it's an opposite transaction, so it's not a zero-sum game. You say someone buys a call, someone sells a call, someone made money, someone lost money. That's not how it works exactly. So are we just picking the wrong stocks, or do we just have the wrong timing because of these unexpected market events that kept coming out of anywhere? Well, it also has to deal with structure. Structure is probably the main key. As we know, there are management techniques for each strategy. You can roll down your covered call. You can make an adjustment. You can adjust your spread position. I teach 8 ways to manage a credit spread and 7 ways to manage a debit spread, probably about 2 to 3 times a year. We go through different ideas. We evaluate those different ways that we teach to manage a spread that goes against you. But that management may need to be managed further down the road if the stock doesn't do what you expect next. And we know management is necessary. Management is almost as important, if not more important, than picking the right stock, picking the right timing. I can't just put on a trade and expect it to work and then say, hey, well, I've hit expiration, I didn't do any management, I'll allow my loser to take here, and I'll just keep doing this strategy over and over. Hopefully the wins will outpace the losses. Only 33% of you had 70% winners, had more wins than losses. 33% of you were at a 50-50 win-loss ratio. 33% had more losers than winners. If I'm in a covered call and the stock suddenly falls 6 to 8% or more in 2 days, which we've seen multiple times this year, maybe 5 days, we've seen that. So I'm now below my break even, including the premium I generated. I want to stop the bleeding. What's a common practice? Oh, just buy back my call cheap, roll it down to a lower strike. And then the market snaps back 200 points, 250 points, 300 points the next day, and now I'm at risk of being assigned at that lower strike price for a loss on the position. I've got to pay more money now to go back up to a higher strike, and I'm lowering my return each time I do this. Shorter term credit spreads, 1 week out, 2 week out, bull or bear, condors even, those sudden shifts from February 5th to 9th, March 20th to April 5th, starting in the second week of October, first week in November, and the first week or so in December till just about the 20th or 24th. Suddenly, the stock's between my strike prices, or it's below both strike prices, and I'm at an 80 or 90% loss for that spread. Well, I might close my spread at a high debit, move it out further in time, move it down in strikes. Maybe the stock will recover. Maybe I'll get whipsawed again in the next month. If I'd opened a bull put at the beginning of October and the stock fell, broke through my trigger point, went through both strike prices, or just trading between both strike prices, excuse me, middle of October, I say, okay, let me go down to December. Let me close my 50 and 47.5 put for a debit. I've got to roll out to December now and do the 45 and 42.5, or maybe even the 45, 37.5 wider strikes. Much more risk to try to get the credit back that I just paid in the debit in this losing position. Then come November, that spread's threatened again, and come December, it's at a loss. I've got to manage it again. Now I'm probably out till June or July if I'm keeping the same structure and I'm keeping the same strategy. Many repairs or adjustments will take on a higher risk and lower profits. And that's if the stock does what you want it to do next. And many management techniques might extend our position out 6 times, 7 times, 8 times more than our initial trading plan, just to try to get back to break even or have a small gain, and at the same time that might be doubling, tripling, or more the risk we have in the position. So to solve our problems for 2019, we likely need a better structure that won't hurt us too bad when we're wrong. Better than a stop order. Better than a contingent order on those spreads, which can get violated quickly, and before you know it, you're at a loss of 50% of what you had in the spread. And we still want to give us positive and meaningful profits when we're right. What do I mean by that? We think about a credit spread. I've done testing on this, and this is why my weekly bull put credit spread search on power options looks for positions that are at least 2 weeks out in time, 11 to 17 days. Why? Because if I open a weekly spread 5 days out, an investor is going to say, well, I have less time for the stock to move against me. I'm still making a leveraged return of maybe 8, 9, or 10%. Meaning on a 2-point spread, you might be taking in 15 cents, 10 cents, maybe a little bit more. But in a sudden market movement, if I open a 2-point spread, say stock's at 53, I sell a 50 put for Friday, expiration, I buy a 48 put, and I get 15 cents. I'm risking 185 to make 15. I'm a little bit below 10%, but I'm close. Around a 9% gain for a 5-day trade. And then suddenly the stock out of nowhere, the market out of nowhere, hits a snag. We wake up in the morning, our stock opens at 47.20. Now I'm near full loss on this position with only 1 day left to go. I can't manage it for the same expiration. I made 15 cents. I'm looking at a loss of about 175. I can't make that up rolling out to the next week. I can't make that up on a 2-point spread anywhere, even going out to January 2020. I've got to open that up to a 6 or 7, maybe an 8-point spread, and I've got to go out to August or further. That one loss of 185 has now wiped out 14 to 15 previous trades. If I at least go 2 weeks out in time potentially, what do I got? I'm getting 25 cents. So now if I do take a max loss, I might be only wiping out 8 or 9 trades. And that's easier to manage in a portfolio. So what I mean by meaningful profits is it's not worth it to trade a weekly spread even if you only have 4 or 5 days to go. Or a 2-day spread trading SPY positions, for the Monday, Friday, and Wednesday expirations if you're only getting 5 or 10 cents because one loss is going to wipe out 20 to 30 previous trades. That's not a recipe for success. There is a way to kind of be successful with spread trades if you get the right market, but you've got to have the proper structure. Also, having the proper structure in place, we don't need to panic. We don't have to have knee-jerk manage when all of a sudden we wake up and our covered call that we were hoping for a 2% return is now down 8% because the stock gap down 10. Now think about it. That's 4 new trades at 2% gain, 4 out of 5. You take an 8% loss on one covered call, your expectation is 2%. You need to be right 4 out of 5 times. What's that number? That's our 80%, isn't it? No one was right 80% of the time. That's hard to be successful with that structure in this type of markets. Well, can a structure alone solve the problems? Let's take a look. We're now going to delve into these strategies a little bit. The expectations, the win-loss ratio, and see how they may perform over time. And then we're going to take a look at what is possible with a different structure, and could that alone benefit your portfolio. So what I'm going to do right now, I'm going to pause the screen. I'm going to navigate over to radioactivetrading.com. Here we go. Sorry, folks. And what we're going to do here is I'm going to click on the Resources tab up at the top. And inside the Resources tab, there's something called the Trade Simulator tool. Now, there's different variances you can do with this. There's different ways that you can enter positions, enter your numbers. I'll encourage you to play with this later. Just go to radioactivetrading.com, click on the Resources tab, and then click on the Trade Simulator. What this tool is going to do for us very briefly, we're going to put in our goals and our expectations. What is our expected target return? How are we going to control losses in this strategy? What is our win-loss ratio, our probability of loss? We're going to start off with a portfolio amount, some number, and the percent invested per trade. And we're not even going to use commissions for any of these strategies. I can, but we're just going to leave that blank for now and just use this baseline. So what are we talking about? 25% of you said that you were doing stock only. Buying a stock hoping it moves up. You've got a target return. 60% of you said that you were looking to make 10% or more. So let's put our target return at 10%. Let's actually move it up a little bit. Let's go 12%. I buy a stock. My trigger to liquidate is a 12% gain on the position, whether that's 1 month out, within a month, or just a hard 12% number. Now, at the same time, you're probably going to try to use a stop order. You're going to maybe use a stop order of 7 to 8%. If you follow O'Reilly's comments there from IBD or other proper teachings out there using just a basic stop order. What happens to stop orders, though? Stop orders get violated. If I'm at a 7% stop, I open my position, it falls a couple percents, and then boom, we have one of those sudden market turns, and the market opens down 8 or 9%, my stock's down 10%, for example, February 5th to 9th, happened those first couple days, you don't get filled at 7%. You get filled at whatever the market can give us. When the market's down 13% from where we bought it, we get filled at a 13% loss. And sometimes you might take less of a loss than 7%. So we're going to keep our loss limit at 10%. We're going to start off with a portfolio of $10,000, and we're going to put $5,000 into each one of those stock trades every time we open one. And let's put our 50-50 win-loss ratio. Stock only, flipping a coin, regardless of what technicals you're using, fundamentals. You could probably increase that with maybe some good stock selection, some good training, a little bit of luck. But we're just going to flip a coin. And so what do we see here? Oops, sorry. What this tool does is it literally simulates a coin flip. Heads, we win and make 12%. Tails, we lose and lose that 7 or 13% for an average of 10%. If we're wrong more often than right, we can still have a reasonable gain. If, of course, you're right around that 50-50 ratio, but at one point you're going to have to expect a 25% decline. Okay? 50-50, sorry folks, 50-50 win-loss ratio. There we go. See here, we know we need more winners than losers. We need to be right 48% of the time, not near your goals. Only a 2% gain, the break even we talked about. And that's assuming that you're making 12% when you're right. This might have met your goals at one point with a 20% decline over 100 trades, and it might have met your goals at that 10-12% return. That's assuming that you're right 50% of the time, which on average, 50% of you were. But it also assumes that you're making 12% average on your winners, which I don't think we were doing. If we keep it at an average, let's just set it 10% to 10%, what's going to happen? Well, naturally, if we have more losers than winners, strings over time, we're going to be very negative. We're closer to 50-50. We might still end up down 35% with only a small profit to show at one point during that trading record. And here we go, 56% of the, oh, sorry, folks. There we go. Let's get it better. 53%. Making 10% when you're right and only losing 10% when you're wrong. The 25% doing stock trades. Even if you're right more often than you're wrong, you're not meeting your goals. It's a 1% gain. Break even. Didn't meet our goals for 2018. Okay, now let's go back. Let's talk about covered calls. We have a tab here you can do, but I want to take a look here at the 33% of you that said your goals were to make 2% per month, 24 to 30%. That's our target return for a 1 month out trade, maybe 2.5. You're going to get a little bit of hedge for the premium and still set a stop order. So let's set that down now at 7% plus the hedge. And we might be right a little bit more than 50%. Let's put our probability of loss down to 45. So we're going to be right 55% of the time. Again, $10,000, 50% into each trade. What do we get? Even if we're right 61% of the time, we're not coming out ahead. If we're averaging 7% losers and only making 2.5% on the winners, we're going to need to be right closer to 70% of the time. That's just the way the math works. And I'm not saying you're going to hit the 7%, but again, using that stop order, sometimes you're going to lose 15 to 20 with a sudden market movement. You know, Apple, if you had just got into it when you thought the market was turning on December 31st, there's a drop. Yesterday they give that guidance. The stock plummets, was down about 9%. Well, if it opens down 9%, I think it only opened down 8%, you don't get filled at the 7% stop order. You get filled at 8 or 9%, whatever the market can give. The stop is essentially a market order saying, once this is hit, get me for whatever the market is trading. But okay, let's drop this down to 35%. So now with this structure, we're right 68% of the time. Losing 7% when we're wrong, making 2% when we're right, and are still not getting ahead. It's got to be above 70%. And only 33% of you said you were right 70% of the time. It's the structure of the trade. And you could say, okay, now what do I need to do? Now I need to find positions that have more volatility to increase my return. And I got to set a tighter stop because I can't afford these 7% stops. Let me put this at 5%. Okay, we run that. Oh, sorry. We run that, sorry. And now we're kind of meeting our goals there if we're right 63% of the time. Not quite there. 61% of the time. 61 winners, we're close to break even. It's got to be higher. We still got to be, there we go, 68%. Now you're meeting your 20% goals. But I got to tell you something. What did we have to do to get this? We had to look for higher returns on our covered calls, which means more volatile stocks. We also lowered the stop order from 7% to 5%, which means what? We're probably going to have more losses triggered where we won't be getting that 66-70% win ratio that we were having because more losses are going to be triggered at 5% than they were at 7%. So this might not get us to where we wanted to be. I set into 2018 with my trading goals to make 2.5% on a covered call, maybe a naked put. I wanted to use a stop order of 7% to allow some movement, but I wanted to be right 70% of the time. That didn't work. So what do I have to do to be better? I got to get a better stop order, better control, assumed insurance, which is all a stop order is, look for a higher return, which means more volatile and fluctuating stocks. And that's two combinations alone means more fluctuation, more 5% triggers are going to be hit. I'm not going to have the win-loss ratio I want. Now, my friends doing the credit spreads, 25% of you doing the credit spreads. What do we know in a credit spread? Well, in general, if I'm doing a bull put or a bear call, either one, maybe even an iron condor, I'm looking for a position that's out of the money, that has maybe a 75 to 80% probability, only a 25% or 20% probability of loss or less. I'm not even going to talk about the 1 week out trades which only offer an 8% return or less with a 75-80% probability for a 5-day trade. I'm going to talk about going 2 weeks out or a month out. And if I do a 5-point spread, maybe I make 50 cents net credit. Or a 2-point spread, I take in 20 to 25 cents. So what we're talking about there is an 11.1% leveraged return. Yep, you make 50 cents on a 5-point spread. Your true risk is only $4.50. You got to put up the $4.50, and what do you get? 50 cents in. It's 11.1% return on what you're risking. But you're risking 9 to 1, $4.50 to the 50 cents you're planning on making. If you take a full loss of $4.50 in an unexpected event, you just wiped out 9 previous successful trades with this structure. However, we're going to put in some triggers. We're going to put in some management. And on that 5-point spread, I'm not going to allow a 100% loss, the full loss of $4.50. I'm going to hope that the worst I do is 50% loss. I lose $2.50 on the 5-point spread. I lose $1 on the 2-point spread where I took in 20 cents. And I'm going to hope to be right 75% of the time. And we're going to change our adjustments here. I'm only going to adjust, let's say, 20% or so of my total portfolio, maybe 25 instead of 50%. It should be less than that, but let's just look at it. And you take 25% of your portfolio, or $10,000 would have been the 20%, 25% of your total portfolio, and you're going to invest into 4 trades. Put $4,000 into each spread you're opening, looking for an 11% return, not going to take the full loss on the position, only half of it if you're wrong, and you're going to be right 75% of the time. Does it work? Well, no. Here we're right 83% of the time. At one point, we have a 40% return. No one was really expecting that. Some of you, 33%, were in that 2% per month on average, looking for 24 to 30. But over time, strings of winners and losers. We hit a bad market. We have a good market through January. We hit some bad markets here. We're right 83% of the time. We're only at a 0.1% gain. Okay, let's try it again. 76, 33% of you said that you were right 70% of the time. Not more than 80, just 70%. This is a losing record. That's not going to cut it. With this ratio, 50 cents on a 5-point spread, this 11% return that I'm looking at for spread structures, even with limiting it to only half the loss I could take on the spread, I actually need to be right 85% of the time in order to profit long term. Here's that 20 to 30%. But I had to be right 85% of the time with that structure. You say, okay, well, I need to go deeper out of the money. I need to increase this to 15% to make sure that I'm right. Well, what happens if I take positions that have an 85% probability or higher? I'm going to drop this down to maybe 9%, maybe 8%, even going 2 weeks out or a month out in time. And even with the same structure, if I'm only right 81% of the time, that's the lie of leverage. Okay, 81 again, nope, not going to cut it. We got to get up to 85, 87%. 93, there we go. Here's what spread traders hope for when shooting the moon. Doubling the returns, but you had to be right 93% of the time. Only 33% of you are right 70% of the time. 33% of you have more losers than winners. This would have wiped out your portfolio, this particular structure. And those of you that were right 50% of the time, we already saw this would have taken your account down by 50, 60%, or what you allocated to spread trading would have been down 50 to 60%. There is a sweet spot there for that kind of structure. We're not going to talk about it now. Now, we saw the potential for winning, not much, if you were only right half of the time, with setting your target at 10%, which is lofty for a long stock position. Yes, in the first few months of 2018, we might have seen that, but in the rest of it, you would have just had all the 10% losers. You never would have had a 10 or 12% winner. But what if I lower this gain expectation? Let's say I make 7.1% when I'm right. And when I'm wrong, I lose only 4.8% or so. And let's say that I do that 50% invested trade, but I'm right only 50% of the time. Well, here's that return we're expecting, isn't it? Something that actually exceeds our goals for this structure, being right only 50% of the time. Let's be wrong more often than right. Now, naturally, if I'm right more often than wrong, we're going to exceed expectations greatly. But let me be wrong more often than right. And what do we see here? Something strange. Over time, even with a string of losers right off the bat and a string of winners, if I'm setting a target that's 6, 7% when I'm right, but I'm able to control risk to guarantee I don't lose more than 4 or 5% on any position, I can be wrong more often than right and still hit that 10% gain that 67% of us say we started out with our goals for 2018 that weren't met. Structure alone can help you achieve your goals. The proper structure, beyond saying, well, I'm in a credit spread and I made sure that the monetary amount I'm risking on my spread is less than 5 or 10% of my total portfolio. That's not enough in uncertain markets. But there is a structure where you can be wrong more often than right and still make money. And if you're right more often than wrong, my probability of loss is only 40%. Now, let's say I'm right 57% of the time, I can potentially easily exceed expectations as well. Now, am I making up these numbers? No, I'm not. If I go to the track record here at radioactivetrading.com, where Ernie, the president and founder of Power Options, and myself and Greg post our trades, since I've been trading these radioactive trading techniques since 2008, I have 64 total married put positions. The average gain on my winners is 7.1%. Average loss on my losers is only 4.8, and I'm right 58% of the time. But even if I was right only 50% of the time, the proper structure and what we've been able to achieve by properly focusing on limiting the risk first in a guaranteed way beyond the stop order to only single digits, while still leaving the upside open without trying to force maybe selling a call right away to just make that 1 or 2% return. This is exactly what's happened to my posted trades since 2008. Through the crash and beyond, average gains on winners, average loss on losers, and roughly right, I'm sorry, 64% of 68% of the time, 58% of the time, I said that right, 58% of the time, my apologies. But I could be at 50-50, and as we saw, still profit with just the proper structure. Let's see if we can get another one here, 50-50. Oh, I got to change that. There we go. I'll use 48. So there we still see the potential with controlling the risk properly and still giving a potential for wins that are less than what a stock trader might experience, less percentage gain than what a credit spread trader is shooting for. But when the market turns on us for unexpected events, even though all our technicals and all our fundamentals and everything looked right for the underlying security we were trading, but the market pulls it down, if I'm still at 50-50, I can still have a winning track record and a winning year. Okay, and there we have it. The answer to that basic question is yes, the structure alone can solve our problems. Forcing myself into an ideal size trade, controlling risk beyond a stop order, which really is assumed insurance, especially in these volatile and shifting markets. Our structure that we use puts time on our side. I'm not looking for a short, quick burst of a 4-day, 5-day, 2-day trade, or even 14-day trade. I'm looking for something that puts time on my side because I don't want to time my trade and be wrong because the market dictates what happens to the market, not me. I want to trade time. And I'm just talking about the structure. I'm talking about the structure by itself that locks in that risk so you can't lose more than 4, 5, or 6%. You can still see gains that outpace covered calls or naked puts over time without taking that assumed insurance of a stop order. I can still do adjustments inside this structure to do better. So here's what we teach at Radioactive Trading. This is a position we posted for our Fusion subscribers from November 20th, 2018 on Starbucks. Probably the worst time to enter in a stock right before the December decline. Or take a bullish position maybe. But I bought shares of Starbucks at 67.22. Proper structure of putting time on my side. I then bought a far out January 70 put for $7.90. Now that might look expensive. I'm adding over 10% for this insurance policy, this put that I'm buying to protect my position, over 10% of the current cost, so my break even goes up to 75.12. But I'm guaranteed, even if Starbucks fell to 30 tomorrow morning, I'm guaranteed to get 70 back in the worst case scenario. That break even of 75.12 really only hits me if I hold the position all the way to expiration, make no adjustments, accept no dividends if Starbucks pays a dividend, and 395 days from now, January 17th, 2020, if the stock's below 75.12 and I've done nothing, I lose 6%. But this put puts time on my side. Even if the stock falls $5, I'm not losing this time value that I paid into. It's still retaining most of that time value because it's 395 days out. And the worst case scenario, if I did do nothing, held it for 395 days, accepted no dividends, made no adjustments, generated no income, is I could lose 6.8%. That's still within that range of controlled risk, single-digit risk. So this was a real trade, posted for the Fusion subscribers. As you see, the stock is down. But I'm nowhere near that 6.8% loss. Okay? What happened to Starbucks after November 20th? Here's that opening. November 20th, stock we see is around 67, 67.22. And that's when I got in during the trading day. Had a big dip 2 days later. And then we moved back up, right around Thanksgiving. It's 2 years in a row that right around Thanksgiving, when I was at my in-laws' house, and sort of the father-in-law said to me when I came out in the morning, that Friday morning after Thanksgiving, and said, well, guess what happened again? I think it was oil 2 years ago. It was something else this year, but the market just pulled down, right away. All right. In any case, it recovers, goes back to 68, above my stock price, above my purchase price. Trade here was actually at a profit. Now, not a profit that met my goals. But when the stock had moved up to about 68, guess what? That put that I bought from 790 was only down to about 750. It lost 40 cents. Why is that important? Well, because I could have sold the stock at around 68, sold that put for around 75.50, I would have had a gain. The break even at 75.12 is only at January expiration, 395 days away. With the stock just trading at 68, I had about a 0.2% profit on the position. But it didn't last. Had another dip, and then a complete collapse. So, 30 days in, December 24th, Starbucks closes at 60.56, down about $6.65 from our purchase price, almost 10% in 30 days. With movement in between. It's not just went straight down. It came up to a profit, had a little blip, looked like it was coming back, had another little blip. Hey, well, it's going to come back because it did the last two times, and then kerchunk. Market dictated this, not the technicals, not the fundamentals on Starbucks. And then it did come back again. Okay. What would I have done if this was a covered call? If I had bought Starbucks here at 67.22 and sold the 65 call, well, this might not have bothered me. This would have been doing what I wanted. But at this point, I'm kind of worried. Now, if I bought the stock at 67, sold the 65 call for $3, I've got a cost basis of 64. So this might not have been a worry point. But the call might have still had some premium left. I might have been looking at a liquidation loss, but oh good, it comes back. And then we're here. What I likely have done here, I might have bought back that 65 and maybe rolled down to a 62.50. Now as the stock fell, hey, that's starting to look great. And here I'm in a good position where, okay, I had it rolled down to 62.5. Do I want to roll it down to the 60? Oh, no, starting to come back up. But what would have happened with this roll? Moving from 65 down to 62 at that point. There's 62.50. Well, I might have expected let's call it even a 3% gain here. But if I have to roll down, I still got to pay something to buy this initial call back. I'm getting a lower premium here because the market's falling and I'm going to a lower strike, which means I would have reduced this return down to about 1% if I was assigned at 62.50. Now it moves back up. If I get assigned here, I'm not meeting my goals. What would I have thought to do? I might have had to buy back that call and now roll up to a 65, maybe now out to January. Maybe get back to a 2% return, but now instead of a 30-day trade, it's a 60-day trade to make 2%. Not meeting my goals anymore, am I? Not meeting my trading goals at this point. Because it's 60 days and 2% instead of 30 and 2%. And it's at 65. When I started in the money for a better assignment, now I had to roll out of the money to avoid getting assigned for a 1% or less return. Better than a loss, but doesn't match my trading plan. And where are we now going forward? Well, we're right about in here. So this might still be looking pretty good. This might still be looking pretty good to get a sign at 1%, but we had to extend the time. We had to move the strike prices, and we might have added more in. It's not meeting our goals with the management techniques. Okay? What are our goals when we manage a position? Spread trade, covered call, naked put, diagonal, anything. Well, we want to turn a loser into a winner. We want to have a lower break-even point or a better break-even point for our desired direction. I don't want to increase the risk on the position, but that's what happens a lot when you have to manage a covered call or you have to manage a spread position. In that proper structure, knowing that I had a controlled risk of the worst case scenario of only 6.5, 6.8%, was there any need to panic, knee-jerk react with these market movements, the bad news that was coming out? No. When the stock hit 65, I was only down 1.5% on the position because I kept most of that time value in place. When the stock hit 62, I was only down about 2.5, 2.6% in that proper structure because my put is retaining most of that time value. And if I had had the same position I showed you when it hit $60.50, that low price down 9.9%, I could still liquidate the put for some gain in intrinsic value plus a retention of a lot of time value because we're only 30 days in, and it would have been down only 3.4%. Half of the initial maximum risk on the position. And again, what we showed on the trade simulator tool is I can even afford to be wrong at 4.8% or even a little bit more to average out those winners. I didn't have to knee-jerk react at any of these points as I would have with a covered call, bull spread. At this point here, when the stock was down 9.9%, if I had done a diagonal call spread by buying, let's say, an April call and selling a weekly call or a 1 month out call against it, that April call or that June call, when it was down 10% from when it was at 67.22, this would have been a 42% loss on that call. And if I take a 40, 35, 42% loss, I need almost a 90% gain on my next trade to get back to break even. That's what's happening to the structures of our trades, why our expectations are not being met. But I did do an adjustment live. Oh, sorry, I should say during the webinar on December 20th. Since I had that proper structure in place in Starbucks, I reduced the cost basis, I reduced the break-even, and I even managed to reduce the risk by using one of the adjustments we teach at Radioactive Trading. Remember the initial Starbucks position, buy stock at 67.22, and we bought that put for 7.90. That's all factored into the original cost basis of 75.12. On December 20th, Starbucks was down to that $63, $62 price. What did I do? I sold that January 70 put for $10.55. So the stock was down about 4.5 points, almost 5 points, but I had close to a $3 gain on the put. It didn't go to zero. It didn't just go to intrinsic value of $8. It still kept a fair amount of the time value that I paid into. But at the same time, to keep the proper structure in place, after I sold that at $10.55, which would have taken my cost basis down below $64 per share, I bought an April 65 for $4.90. So I took in a credit of $5.65. And you could say, oh, well, yeah, of course, you gained on that put, but you put this back in. But yes, the put went from $7.90 to $10.55, and I used that credit to fund this position. I moved it closer in time, but it's still 120 days out, still 4 months out in time. So I took in a credit of $5.65. Because remember, I'm already factoring in the $7.90 cost to my total position. I get $10.55 out, I put $4.90 back in. I have a new total cost basis of stock plus my April 65 put at $69.47. I lowered the cost basis. And at the same time, this shaved a little bit off of my risk. But what's most important, we lowered the break even by almost 6 points. Almost 10% from where the stock was trading. I shaved a little bit off of the risk, but now the worst case scenario, again, if I hold this position another 4 months and do nothing else between now and April, I could lose only 6.4 instead of 6.8. Oh, and we still left the upside open. I don't have a capped gain for when or if Starbucks recovers. So that insurance that put me in the proper structure is not just a wasting asset. It is a proper structure because even with the stock down, I have a way to lower the break even, shave down the risk, and I can still do adjustments going forward without the fear of a leverage spread, without the fear of increasing my risk to manage. I still have that long-term second working asset that I can use in my favor. And we almost got to break even a few days later. On December 31st, as we saw, once we hit that bottom around the 24th, Starbucks came back up. It moved back up to 64.40. If I had sold the stock then, remember we did this when the stock was around 62.20, 62.40 or so. But at this point, the stock has moved back up to 20. I paid $4.90 for the put, but it's only lost $1. So I could have liquidated the position at that point for 68.30, which is a loss of 117. Wasn't quite at break even, but that's only 1.6% of what I have invested in the position. And remember, the stock is down 4.2% from where we started at 67.22. I kept the proper structure. I didn't liquidate it this time. I was still in the trade. But I'm not near that max loss of 6.4% at all. The stock's still down 4 or 5% from where I started. And I still have time on my side. Why did I choose that adjustment? Because it matched my goals for this particular trade. It matched my goals of what I want to see for management. I don't want to necessarily increase my risk and lower my return. I don't want to be in a structure where I know management is essential and every time I manage, I'm either increasing risk or I'm lowering the potential for return. I want to be at a proper structure that if I do feel that I can manage it to benefit the position, I want to lower risk, lower the break even, position myself for higher returns if the stock recovers, and still be able to do other adjustments that won't increase the risk as well. Now, I could have sold a call. Simple structure. It's something I do inside of these proper structure radioactive trades, but it would have actually put me in an opposite structure. And I could have sold a call after making the adjustment. You know what I'm saying here is when the stock was falling, and instead of keeping the 70 put and then selling a 62 or a 65 when Starbucks fell to $62 or so, I could have sold a call to hedge the loss, but it would have put me in a bearish structure. My sentiment was the stock was going to recover. It's not what I want to do. And after I made that adjustment to shave a little bit off the risk, lower my break even, I could have sold the call, but it wouldn't have given me a profit. On December 31st, not when I made the adjustment, but after the stock recovered, I could have sold a January 65 call for $1.10. So on December 20th, when the stock was at 62.50-ish or so, we moved that put down, shaved a little bit of risk, and lowered our break even. Now on December 31st, the stock goes up to 64.40. It recovered. The January 65 call was at 110. It did reduce my risk very well to that range I was talking about, the average of 4.8, 4.9%. But now I'm in a no-win trade. Sure, if it's trading right around $65 on January expiration, I'd be at about a loss of 0.7% total on the position. Yes, if that call expires, I would have hedged my loss to only 4.9%. But if I'm expecting a recovery and the stock to move back up, this puts me in a position with 2 ways to lose and no profit here. I don't like that. And I don't have to force this because I still have a controlled risk of only 6.4% in the absolute worst case scenario. Right now I'm looking at a loss of only about 1.6%, well below all of the loss limits we showed using a stop limit on a covered call position or a stock only position. And that's where I am right now. I don't feel the need to force income because I don't want to put myself in an improper position or an improper structure. Think about just the structure alone. Even though the put is further out of time and I've got time on my side, if you enter trades like this, how many times would you have to be right in order to profit long term? Well, it's over 100%. You can't win. So this isn't the proper structure. I looked at it. I may sell a call at one point, but only if it puts me where I want to be. I don't feel pressure to adjust further. I don't feel stress to try to roll down, roll back up, roll sideways, move my spread 4 months out, and then sit there and try to watch it for 4 months. I don't have to do it. We kept the position just as it is right now with only that 6.4% loss on the trade. In the absolute worst case scenario, still all the way out to April, and right now only sitting on a 1.5% loss. With the stock still down 5% from our original purchase price. Now, is that still the proper structure? Absolutely. I didn't have to roll back and forth with the covered call position. And we talked about using an in-the-money one for better protection. If I'd bought the stock at 67, sold the 65 call, watched it fall to 62, rolled down to the 62.50, came back up to 64, I've got to move it back up to 65. If I had done an out-of-the-money call and received less premium, I probably would have rolled down to the 67.50 and the 65. Maybe still sitting okay, but it would have consistently lowered my max return as I rolled down. If I had done a spread position, even when Starbucks looked good technically, which it did on December 20th, a lot of stuff was still going on. I'm sorry, November 20th. My apologies, November 20th. And then right after Thanksgiving happened. Then December happened, outside of the bounds of control of the stock itself or the performance of the stock itself. But I didn't take an 8-to-1 loss ratio. I didn't have to close the spread taking a 50 to 70% loss and maybe rolling it out 4 or 5 months and then hoping that it recovers just to watch it fall again, then bounce back a little bit. Because I had the proper structure in place to begin with, I didn't feel the need to adjust, the stress to adjust, the pressure to adjust, even when the stock was down 6, 7, 8, even 9%. I could have left it alone. I applied a management technique on it because it gave me a management that lowered my cost, lowered my break even, and even lowered the risk. So if it did recover as I was hoping, I could have higher returns sooner. And if it didn't recover, I even shaved a little bit off the risk as well instead of increasing it. And maybe I could have done better by selling that call right now, hindsight 2020, but that was not the proper structure. Because there's no way to win in that ratio without assuming management. So I want you to just think about that for a second. And this is just one adjustment I could have used, but think about that adjustment that lowered the cost, lowered the break even lowered the risk with the stock down. Am I in a bullish position? Absolutely. But even though the stock went against me, I was able to satisfy the 3 main goals of an adjustment which usually aren't met in other strategies. So just with that alone, just the Starbucks adjustment and the proper structure, how would cutting your risk down by 50%, all of your losers over the last year, if you cut the loss percentage down by just half of what you took, how would that have affected your year? Now, I didn't cut the risk in half, but there were opportunities to do that. But if you had just taken half the losses you took in 2018, half of the percentage losses, still with the same win-loss ratio, would that have put you in a better position? Would you may have still lost in 2018, but lost much less? Would it have turned a losing year into a winning year? Would you have easily have met your 2018 expectations had you cut your losses by half with a better controlled structure? Would you have exceeded your expectations for 2018, which we saw weren't met earlier? Or do you think that cutting your losses by 50%, half of what you took on your losing positions, would not have helped your portfolio? All right, so I'm going to leave this poll open for a little bit longer. I encourage you to vote. And remember, this is all based too on what we did this year. 67% of you were looking for goals of making 10% or more. 33% of you were looking to make 2% or more per month. And unfortunately, 25% of you came close to meeting your expectations, 50% of you are break even, and 25% of you would have turned losing trades into winners. I'm sorry, 25% of you are ready to just quit the market. Sorry, look, I'm reading the wrong numbers here. All right. So, if looking back in 2018, you'd have controlled your risk and lost half on your losers that you lost in 2018. Well, what we have here is that 40% of you say you may have lost, but would have lost much less. I'm sorry, was that, yeah, 40% say you would have lost, but lost much less. 12% said it would have turned your losing year into a winning year. 30% said I easily would have met my expectations, and it looks like 8% say cutting my losses 50% would not have helped. Okay, well, it still would have benefited. Even if you only would have made you, even if you still would have lost, you'd have lost much less. Still would have had more money going into 2019. And if it would have turned your losing year into a winning year, and we're just talking about the basic structure by itself, where do you want to be in 2019 when I ask this question again? Or January 4th, 2020, if I ask this question again, what do you want your answer to be? Those of you who said it easily would have met your goals for 2018, where do you want to be when I ask this question again? And for those of you who said that cutting your losses by 50% would not have helped, well, maybe I encourage you to take a coaching session at Power Options with myself or Ernie, because you may be over-positioning your trades. You might be doing those spreads and over-positioning those strategies there, meaning that you're putting too much of your portfolio into those positions, so even if you would have cut your losses by half of what you took, it still wouldn't have mattered. You might be over trading in some of those leverage strategies, and that's why you're seeing it. But we showed today why the structure itself, with just the proper structure alone, could have bettered your trading portfolio for 2018, and where we want to see it go in 2019. But that's just the start. I showed one of the ways that I made an adjustment that actually satisfied everything I'd want to do with an adjustment when a stock is moving against you. When your trade is moving against you, I was able to lower the risk, lower the cost basis, and lower the break even. And that's just one of 12 ways that we adjust this proper structure. There are other ways to adjust that proper structure, the starting point of controlled risk with the unlimited upside to generate income. Further lower that initial at risk. And something that we do, Ernie and myself do, maybe about 30% of the time, 30% of our trades, which is cancel all of the risk, which we call bulletproofing. And put myself in a position to increase the profits, all without the fear of being wrong. And we also showed that even if I'm only right 50% of the time, as 33% of you said you were in 2018, I could still have a winning record and meet my trading goals with the proper structure in place. And that is what we teach in the blueprint, the full manual that discusses the proper structure, putting time on your side, when and how to use these 12 adjustments. And they're not complex. They're things that you're doing right now with options and with options investing, but without the fear of risk, without the fear of leverage or an 8-to-1 risk-reward ratio, because it's inside the proper structure. But why are there 12? Where it's for different markets. The structure as a whole is a bullish strategy. And sometimes the stock goes up, and we've got adjustments that can greatly reduce that initial at risk, still leave time on your side, still be able to generate income to further lower that initial at risk. Stock market feels stagnant, it's not really moving. There's adjustment to use in that scenario as well. And that's all explained what they are, when to use them, how to use them, and what to look out for and what to plan for if you do that type of adjustment. And of course, sometimes the market just goes down. And we have ways to adjust positions without taking on any additional risk, some with adding a little bit of risk, but to benefit in both directions. That's what I did with that pen trade that I was in for 30 days and dropped 33%. I was long stock the entire time, but closed the position after 35 days with a 10.3% return. Of course, the blueprint also contains case studies, chapters on combining income methods, combining adjustments, exiting the trade, the proper structure, and the proper stocks to look for that have worked for us over the last 10, 15 years of trading this technique in our personal account, as we showed. And I just want to remind everyone, now is the last chance to pick up the blueprint before January 6th to get advantage of the 7 end-of-year bonus offers. I already wanted me to extend it through January 6th. What do you get with these 7 bonuses? If you pick up the blueprint before January 6th, you're going to get access to 2 months of the Fusion account where I post my trades. Ernie posts his trades. You can learn from them. There's lessons there to help you master the techniques as well. In addition to that, there's also tools to help you find new trades with the proper structure in place. You'll get 2 months of Fusion at only $10 per month. It's usually $59 per month. You can take 2 months, watch our trades, follow what we're doing, follow the lessons for only $10 per month, $20 total. You're going to get one of our Mastery Series CDs, Mastery Series videos, I should say, for free. It's one of the 6 Mastery Series videos to help you get introduced to the technique and go through the income methods. You're also going to get 1 month of power options, where we do support 23 of the commonly used option strategies as well. You're also going to get free email and phone support at any time, and the blueprint is a 250-page text contained in a 3-ring binder. We ship it out to you, but we're going to waive the shipping cost as well. You also get a money-back guarantee. For whatever reason you're not satisfied with the content, you can send it back to us. We'll refund your purchase price, no questions asked. But we're only going to leave it open, through January 6th. So you want to act now. You want to go to radioactivetrading.com/EOY, or you can just go to radioactivetrading.com and click the Products tab. You'll see more information, how this can work for you. You'll get the full benefits of those 7 bonuses if you pick it up by Sunday, and it's completely risk-free. It's a bulletproof transaction on its own because you have the ability with a money-back guarantee. It's a bulletproof trade to begin with. There's no risk to you, but as we already showed, you can see how the proper structure itself, without even considering the income methods that can be used in different market conditions, unlike other strategies, that proper structure alone, if you find yourself only being right 50% of the time, you can still profit long-term with the proper structure. You don't feel the pressure or the stress. You don't need to spend 4 hours a day, 3 hours a day managing positions, rolling spreads, opening new spreads at only 2 to 3 days to expiration. Time is not only on your side, but you don't have to spend a lot of time with the proper structure itself. You can choose to make an adjustment or not, based on what matches your goals for the position and what matches your goals for 2019. And that's what the blueprint can do for you, teaching you the radioactive trading techniques to put these trading goals for 2019 where I want to control risk. I don't want to spend a lot of time managing or adjusting trades. I don't want to have that terrible gut feeling of waking up in the morning and seeing the market go in an opposite direction and panicking to adjust my spreads, adjust my covered calls, my diagonal spreads, my straddles, my strangles. even if the worst case scenario comes true, I've controlled the risk with a guaranteed position, a guaranteed structure. But it's not just insurance. It's a second asset that works in my favor. So I can satisfy all my goals for 2019. And if 2019 turns out to be a better year than 2018, market-wise, volatility-wise, I'll be able to exceed my expectations because I had the proper structure in place to begin with, put time on my side, and stacked the market odds in my favor and avoid the lie of leverage. Again, just to go to radioactivetrading.com/EOY to get more information on the 7 bonuses and what the blueprint can do for you. Or just go to radioactivetrading.com and click the products tab. Of course, you may have questions. I understand that, but if you have any questions, give me a call at 302-992-7971. You can also email me at any time at support@radioactivetrading.com. Well, ladies and gentlemen, thank you again for joining me today. Happy 2019. Happy New Year to you once more. And I look forward to seeing you in our upcoming presentations next week and into 2019 as we see what's happening in the market, plan for what's happening in the market, and keep our proper structure in place. Good night.